The DFI reads the model. Revenue assumptions look solid. DSCR 1.38 times in the base case. Equity IRR 19%. The numbers work. Then they ask to see the offtake agreement. There isn't one yet. The developer has a letter of intent from the national utility and a term sheet that expired 8 months ago. The DFI closes the model. Without a signed bankable offtake agreement, the revenue in your financial model is a forecast, not contracted cash flow. A DFI lends against contracted cash flows, not against forecasts, not against letters of intent, not against regulatory frameworks, against signed offtake agreements with creditworthy counterparties and bankable terms. Episode 9 shows you how to structure one.
Zara, this feels like the foundational question in African project development. Every developer I speak to knows they need an offtake agreement, but very few understand what makes one bankable versus what makes one just a signed piece of paper. What is the core difference?
The core difference is whether the offtake agreement answers 3 questions in the DFI's favor. 1. Is the offtaker creditworthy enough to pay the tariff for the full term of the loan? 2. Does the contracted revenue, specifically the take-or-pay floor, cover debt service and fixed OPEX in every year of the loan life? 3. If the offtaker defaults or terminates, does the developer receive enough in compensation to repay the outstanding debt? If any of those 3 answers is no, the offtake is not bankable, regardless of how well it is drafted. An offtake agreement is the contract that converts project output into bankable revenue. The type of offtake agreement depends on the sector. In energy, it is the power purchase agreement, the PPA, where the offtaker buys electricity output at a contracted tariff. In water and sanitation, it is the offtake and supply agreement, the OSA, where a government water utility buys bulk treated water. In transport, it is a concession agreement granting the right to collect tolls or fees. In gas and industrial supply, it is a bulk supply agreement. And in some government infrastructure projects, a management service agreement removes demand risk entirely by paying the developer an availability fee regardless of volume consumed.
The management service agreement model, where government pays for availability regardless of usage, seems like the developer's ideal structure. Is it common in Africa?
It is increasingly common, particularly for water and sanitation projects where government does not want to take volume risk, and for road projects where traffic forecasting is too uncertain for a pure toll concession. The availability fee model transforms the revenue risk from demand risk to credit risk. The question is no longer, will people use the facility, but will the government pay the availability fee? That credit question is actually more tractable because you are assessing one counterparty's payment capacity rather than uncertain market demand. From a DFI perspective, availability-based payments are strongly preferred for exactly this reason. Let me take you through the most important offtake structure, the PPA. The power purchase agreement has 5 core components: the capacity charge, a fixed payment per megawatt of available capacity, paid regardless of whether the offtaker dispatches the plant. This covers the developer's debt service, fixed OPEX, and equity return. The energy charge, a variable payment per megawatt hour actually generated, covering fuel and variable O&M. The tariff escalation formula, an annual increase mechanism linked to CPI, a USD rate index, or a fixed percentage. The availability guarantee, the developer is paid if the plant is available even if not dispatched. And the fuel supply provision, defining whether the developer or the offtaker supplies and bears the cost of fuel.
Why does the fuel supply provision matter so much for bankability? I've seen both structures, developer-supplied and offtaker-supplied fuel.
From a DFI perspective, offtaker-supplied fuel is strongly preferred because it removes fuel price risk from the project's cash flows. If the developer supplies fuel and the fuel price doubles, OPEX doubles, DSCR falls, and the debt service coverage deteriorates. The DFI must then model fuel price volatility as a sensitivity variable. If the off-taker supplies fuel, the developer's revenue is purely the capacity charge and availability payment, predictable, contractual, and insulated from commodity price movements. The financial model becomes more stable, the DSCR is more defensible, and the facility is easier to size. In practice, where the off-taker is a government utility, government bears the fuel supply risk through the utility's procurement system, which is appropriate since government controls the regulatory environment. The tariff structure is the architecture of the revenue line in the financial model. Every component of the tariff must be traceable to a contractual or benchmarked source. The capacity charge is sized based on CAPEX, IDC, debt service, and fixed OPEX. The developer backsolves from required revenue to a per megawatt tariff. The energy charge is sized from variable O&M and fuel cost where applicable. The escalation formula must match the OPEX escalation assumptions in the financial model. If the model escalates OPEX at CPI, the tariff escalation clause must also reference CPI. A mismatch between revenue and cost escalation creates an eroding margin that the DFI's sensitivity analysis will expose.
What is the DFI's most common challenge to the tariff in an African PPA?
3 challenges dominate. First, the tariff is above comparable regional transactions. The DFI benchmarks your PPA tariff to comparable projects across the subregion. If yours is significantly above comparables without a clear cost justification, the DFI will push back. Second, the tariff includes uncapped CPI escalation. A tariff that escalates at CPI with no cap is not bankable because the off-taker's payment obligation grows unconstrained over the PPA life. Government treasuries will not approve it. The DFI requires the escalation to be capped or predictable. Third, the tariff is denominated in local currency, but the debt is denominated in USD. That currency mismatch is modeled as a 30% stress in the downside case by most DFIs. The tariff must include an FX indexation mechanism. The take-or-pay provision is the mechanism that converts volume risk into payment risk and makes the revenue bankable. Without take-or-pay, the developer only gets paid when the off-taker actually takes delivery of the output. With take-or-pay, the off-taker must pay for a minimum contracted volume, typically 80 to 90% of contracted capacity, whether or not they take delivery. From the DFI's perspective, the take-or-pay floor is the revenue floor on which the debt is sized. The debt service coverage calculation is run against the take-or-pay floor, not against the full contracted capacity. That floor must cover debt service and fixed OPEX with a DSCR of at least 1.10 times in the downside scenario.
What happens to the revenue the developer earns on volumes above the take-or-pay floor?
Revenue above the take-or-pay floor flows through the cash waterfall in the normal sequence: OPEX, then debt service, then reserve funding, then equity distributions. The take-or-pay floor sets the minimum. Actual revenue can be higher if the off-taker dispatches above the floor. This upside is why equity investors accept the take-or-pay floor as a floor and not a ceiling. Now, the 5 bankability tests a DFI applies to the PPA. Test 1. Off-taker creditworthiness. Can this off-taker actually pay the tariff for 15, 20, or 25 years? DFIs look at credit rating, payment history, government backing, and the utility's billing collection rate.
What if the off-taker is a government utility that has no credit rating and a history of payment delays to other suppliers?
Then you need credit enhancement before the DFI will proceed. The primary instruments are a Ministry of Finance guarantee, an explicit written commitment by the National Treasury to backstop the utility's payment obligations, a pre-funded escrow account covering 3 to 6 months of tariff payments pledged to the DFI, a partial risk guarantee from the AFDB, World Bank, or Majeure, which transforms government payment risk into DFI credit risk. The international institution backstops the off-taker's payment default, and a letter of credit from an international bank that the developer can draw on if the utility fails to pay. These instruments exist precisely because most African utilities are not investment-grade counterparties. The developer who waits until DFI engagement to discover the off-taker is uncreditworthy, loses 6 to 12 months building the credit enhancement structure. The offtake and supply agreement for water follows the same bankability logic as the PPA, but has sector-specific features. The tariff is a bulk water rate per cubic meter delivered at the offtake point, the handover between the developer's treatment plant and the government distribution network. The minimum offtake provision guarantees payment for a minimum daily volume regardless of actual consumption by end users. This is critical because end-user demand can fluctuate. The water quality specifications define the treatment standard, typically WHO drinking water guidelines or national standards. The tariff includes an escalation mechanism linked to CPI and O&M cost pass-through provisions where major maintenance costs are passed to the government offtaker.
Government payment risk for water seems even more pronounced than for power, given that many African water utilities are heavily subsidised. How do developers and DFIs approach that?
You are right. Most African water utilities operate below cost recovery tariff levels, meaning their revenue from end-user billing does not cover the cost of bulk water procurement from the developer. The gap is filled by government subsidy. The DFI's assessment focuses on whether the government has explicitly committed to funding that subsidy through the lifetime of the offtake. The credit enhancement instruments we discussed, Ministry of Finance Guarantee, Escrow, PRG, are almost always required for water offtake transactions. The additional mechanism specific to water is the tripartite agreement. Government, utility, and developer sign a tri-party agreement that makes the Ministry of Finance directly liable for payment obligations, rather than just guaranteeing the utility.
Can you explain the partial risk guarantee? How does it actually work in practice?
A partial risk guarantee from AFDB or the World Bank Group is a commitment by the multilateral institution to pay the developer if the government defaults on a defined set of payment obligations. The PRG backstops a specific risk. In this case, off-taker payment default. When government fails to pay the tariff within a defined cure period, the developer makes a claim under the PRG, the multilateral pays, and the multilateral then has a claim against the government through its sovereign relationship. The effect is that the developer and the DFI are effectively lending against the credit of the multilateral institution rather than the government utility, which transforms the credit quality of the transaction entirely. PRGs are a powerful tool, but they take 6 to 12 months to negotiate and are subject to the multilateral's own board approval process. The termination provisions determine what happens financially if the offtake agreement ends before the debt is repaid. There are 5 termination scenarios, and each has a different compensation structure. Off-taker default, non-payment after a cure period, triggers a termination payment covering outstanding debt, breakage costs, and a reasonable equity return. Change-in-law termination, where a regulatory change makes the PPA uneconomic, triggers outstanding debt plus reasonable equity return. Political force majeure, government action preventing project operation, triggers outstanding debt plus equity return, with government bearing the payment obligation. Convenience termination, off-taker terminates without cause, triggers the highest compensation, full project value, including the net present value of future equity distributions.
And termination triggered by developer default. What does the developer receive in that case?
On developer default, the developer receives outstanding debt only, no equity return, and the DFI's claim has priority. This asymmetry is important. The developer has a strong incentive to maintain performance because default forfeits all equity value. From the DFI's perspective, the termination compensation for off-taker default and change-in-law scenarios must be sufficient to repay the outstanding debt facility plus transaction costs. This is a non-negotiable covenant condition. The DFI will model the termination payment against the outstanding debt in the first year of operations, the midpoint of the loan, and in the last year, to ensure coverage is maintained throughout the loan life. Any gap in termination compensation coverage will be identified and must be addressed before financial close.
What about force majeure, and specifically the change in law clause? I see these two provisions conflated frequently in African PPAs.
Force majeure and change in law are fundamentally different. Force majeure covers events outside any party's control, natural disasters, war, political disruption, that prevent performance. It suspends obligations but does not trigger compensation in most structures unless the FM event is attributable to government action, in which case it becomes political force majeure. Change in law is different. It covers deliberate government policy decisions, regulatory repricing, new taxes, import duties, sector restructuring that change the economics of the project. Change in law compensation must cover the increase in project cost or decrease in revenue caused by the policy change. The DFI requires the change in law clause to explicitly cover the debt service impact, not just operating costs. If government reprices the tariff down by 20% and the change in law clause only covers OPEX impacts, the debt service gap is unprotected. That is a fatal flaw. Currency risk in the offtake agreement is one of the most consequential structural decisions in African project finance. The core question is, in what currency is the tariff denominated? If the debt is in US dollars and the tariff is in local currency, any devaluation of the local currency reduces the USD equivalent of the revenue stream and deteriorates the DSCR. Most DFIs apply a minimum 20% FX devaluation stress in their downside scenario. The solution is either a USD-denominated or USD-indexed tariff, where the tariff is set in local currency but indexed to the prevailing exchange rate so that devaluation triggers a corresponding tariff increase, or a dual currency structure where the capacity charge, which covers debt service, is in USD and the energy and O&M charge is in local currency.
What if the government or regulator refuses to agree to a USD-indexed tariff? That happens frequently in countries with active forex controls.
If a USD-indexed tariff is politically unavailable, the developer needs two things. First, a currency hedge, a forward contract or cross-currency swap that locks in the exchange rate for debt service payments. The hedge cost must be budgeted in OPEX and included in the financial model. Second, a hardship clause in the offtake agreement. If FX movement exceeds a defined threshold, either party has the right to renegotiate the tariff to restore the project's economics. The DFI step-in rights, the direct agreement, provide a third layer of protection, but they are protective rather than preventive. The developer who structures the FX provisions correctly before signing the PPA avoids the problem. The developer who relies on hardship clauses after signing is already in a restructuring conversation.
Let's talk about the DFI's direct agreement and step-in rights. How does that work in practice?
The direct agreement is a tripartite contract signed by the DFI, the developer, and the offtaker. It gives the DFI direct rights against the offtaker, independent of the developer. The key provisions are step-in rights, which allow the DFI to take over management of the project if the developer defaults on the loan. A cure period of typically 60 days during which the DFI can remedy any developer default before the offtaker terminates the PPA. Quiet enjoyment, a commitment by the offtaker not to terminate the PPA during the cure period, and the right to assign the offtake agreement to a substitute developer if the DFI steps in and sells the project. The offtaker must consent to the direct agreement, negotiate it into the term sheet from the beginning, because retrofitting it after heads of terms are agreed is very difficult.
What are the 7 most important terms to negotiate in any offtake agreement, regardless of sector or structure?
The 7 key terms are 1. The take-or-pay floor, which must cover debt service plus fixed OPEX. 2. The termination compensation on off-taker default, which must cover outstanding debt plus breakage cost. 3. The change in law clause, which must explicitly cover the debt service impact of any regulatory change. 4. FX indexation. The tariff must be USD denominated, USD indexed, or accompanied by a defined hedge mechanism. 5. The PPA term, which must exceed the debt tenor by at least 2 to 3 years. 6. The cure period in the direct agreement, which must give the DFI 60 days to remedy developer default before off-taker can terminate. And 7. The dispute resolution mechanism, international arbitration under ICSID or LCIA rules, not local courts. These 7 terms are non-negotiable from a DFI perspective. Everything else is context-dependent.
And the 7 mistakes, the things that actually get PPAs rejected or renegotiated before DFI approval.
Mistake 1. No take-or-pay floor. The PPA relies on the off-taker dispatching for revenue. The DFI cannot size debt against demand-dependent revenue. Mistake 2. PPA term shorter than or equal to the debt tenor. A 15-year PPA with a 15-year loan forces refinancing at maturity at unknown interest rates. The DFI rejects it. Mistake 3. Unrated off-taker with no credit enhancement. No government guarantee, no escrow, no PRG. The DFI cannot lend. Mistake 4. No change in law compensation clause. Government has an implicit option to reprice the tariff. Without the clause, the developer bears unlimited regulatory risk.
And the remaining 3 mistakes?
Mistake 5. Local currency tariff with USD debt and no FX mechanism. The developer has built a structural currency mismatch into the project from day one. Mistake 6. No termination compensation clause covering the debt. The DFI's loan is unsecured against off-taker default. The DFI will not approve. Mistake 7. No direct agreement or step-in rights. The DFI has no contractual relationship with the off-taker and cannot protect its security interest if the developer defaults. Every one of these mistakes requires the PPA to be renegotiated before financial close, adding 3 to 12 months to the timeline. The developer who structures the offtake correctly from term sheet stage avoids all of them. Let me close with sector-specific offtake structures. For renewable energy, NIPP, the standard is a PPA with the national utility featuring capacity and energy charges, USD index tariff, 85 to 90% take-or-pay, and a term of 20 to 25 years. The DFI benchmark is a USD index tariff, a take-or-pay floor covering 1.10 times debt service in the downside, and a PPA term at least 3 years longer than the debt tenor. For water and sanitation, the standard is an OSA with a government water authority, bulk tariff per cubic meter, minimum volume guarantee, and availability-based payment preferred. The term is typically 20 to 30 years.
And for transport and digital infrastructure, those sectors are growing fast, and developers often ask us how to structure the offtake there.
For transport, roads, bridges, ports, the choice is between a toll concession, where the developer collects traffic-dependent revenue, and an availability payment structure, where government pays a fixed annual amount for the asset being available and maintained. The availability model is preferred by DFIs for the same reason as water. It replaces demand risk with credit risk. Where a toll concession is used, a government top-up or viability gap funding mechanism must be in place to cover debt service in years where traffic is below forecast. For digital infrastructure, towers, fiber, data centers, the anchor tenant agreement is the functional equivalent of the PPA, a long-term capacity contract with a creditworthy anchor tenant providing a guaranteed revenue floor. Co-location revenue is additional upside. The DFI requires the anchor tenant to cover at least 60% of projected revenue.
For a developer who is currently negotiating a PPA or OSA with a government offtaker, what should they prioritise engaging AIB Corp Ltd on?
Engage us at the term sheet stage, before heads of terms are agreed with the offtaker. The most expensive offtake mistakes are the ones that get baked into the heads of terms and then take months to renegotiate. We structure the offtake from the DFI's 7 bankability tests: creditworthy offtaker, take-or-pay floor, term alignment, change in law coverage, FX indexation, termination compensation, and direct agreement. We also conduct the counterparty credit assessment on your behalf, reviewing the offtaker's payment history, credit profile, and government backing, and advising on what credit enhancement is required before approaching a DFI. The offtake agreement is the credit story of the project. Build it correctly, and the DFI engagement is a confirmation process, not a negotiation. Details at w.aibcorpltd.com.
Zara, let me summarize. The offtake agreement is not just a commercial contract. It is the document that converts project output into bankable revenue. Without a bankable offtake, there is no project finance, only a business plan. The DFI's analysis starts here. Who is the offtaker? What do they guarantee to pay? And what happens if they don't?
The key structural elements are take-or-pay floor covering debt service, USD indexed or USD denominated tariff, PPA term exceeding debt tenor by at least 3 years, termination compensation on offtaker default covering the outstanding loan, change in law protection covering the debt service impact, and a DFI direct agreement with step-in rights and a 60-day cure period. If any of those elements is missing, the PPA is not bankable, and the DFI will tell you at credit committee after months of due diligence.
The insight I take away is that the offtake agreement and the financial model are two sides of the same document. Every structural choice in the PPA drives a number in the model. The take-or-pay floor drives the minimum DSCR. The FX provision drives the downside stress. The termination compensation drives the DFI's security position. They must be designed together, not sequentially.
Precisely. The developer who designs the offtake and the financial model in isolation ends up in a restructuring conversation. The developer who designs them together, starting with the DFI's requirements and working back to the offtake terms, is the developer who closes on schedule. That is the AIB Corp Ltd approach. Start with the lender's requirements, structure backwards, close efficiently.
If you are negotiating a PPA, OSA, or concession agreement for an African infrastructure project and you need it structured to DFI bankability standards, go to www.aibcorpltd.com. AIB Corp Ltd structures offtake agreements for energy, water, transport, housing, and digital infrastructure transactions across Africa. Confidential initial consultation available.
Subscribe to the AIB Corp Ltd channel. New episode every week. Episode 10 covers the EPC and construction contract for African infrastructure. We will cover lump sum turnkey structures, risk allocation between developer and EPC contractor, liquidated damages, performance bonds, construction insurance, and the interface between the EPC contract and the DFI facility agreement.
If this episode helped you understand what makes an offtake bankable, share it with a developer who is currently in PPA negotiations. The earlier they get the structure right, the less expensive the journey to financial close will be. See you in episode 10.
One final point. The offtake agreement is the document that defines the risk sharing between the developer, the offtaker, and ultimately the DFI. Every risk that sits with the developer that could have been allocated to the offtaker is a risk the DFI must price. The better you allocate risks to the party best able to bear them, and document that allocation in the offtake, the lower your cost of capital will be. Structuring the offtake correctly is not just about compliance. It is about optimizing your capital stack from first principles. AIB Corp Ltd. www.aibcorpltd.com.
Let's also recap the 7 key negotiation terms. Take or pay floor covering debt service. Termination compensation covering the outstanding loan. Change in law covering debt service. FX indexation or hedge mechanism. PPA term exceeding debt tenor by 3 years. 60-day cure period in the direct agreement. International arbitration for disputes. These 7 terms should be on a checklist in every PPA negotiation across the continent.
And the 7 mistakes to avoid. No take or pay floor, PPA shorter than debt tenor, unrated off-taker with no credit enhancement, no change in law clause, local currency tariff with USD debt and no FX mechanism, no termination compensation covering debt, and no direct agreement. Avoid these 7, and your PPA will survive DFI review. Introduce any of them, and you are adding months to your financial close timeline.
This has been episode 9 of AIB Corp Ltd. Subscribe for episode 10, the EPC and construction contract. Follow AIB Corp Ltd on all platforms and go to www.aibcorpltd.com for our full suite of advisory services for African infrastructure transactions.
The series continues. 8 episodes have covered the full journey from concept identification to offtake structuring. Episode 10 moves to the construction phase, how the EPC contract is structured, what risks the contractor takes on, and how the DFI facility is drawn against EPC milestones. Every layer of the project has to be bankable. The offtake is the revenue layer. The EPC contract is the cost layer. Get both right and the capital stack locks together.
See you in episode 10.